Hi and welcome to Market Conversations. So it's been a while since I did a video, and in this video I'm going to go ahead and place a trade on natural gas futures. So I've been trading natural gas since the beginning of this year, and it's been okay for me so far, better than other trades. And let's go ahead and take a quick look at a 9 months daily chart. So you see here that natural gas has just been trading in this range of 2, and it did hit 3 about a month ago. So it's just been trading in that range. And prior to that, it did go to a high of 10 and it just sold off. I'm going to go ahead and show you a description of natural gas. What are natural gas futures? The Henry Hub natural gas futures contract is widely used as a national benchmark price at 10 million British thermal units. The price is based on delivery at the Henry Hub in Louisiana, the nexus of 16 interstate natural gas pipeline systems that draw supplies from the region's prolific gas deposits. The pipelines serve markets throughout the U.S. East Coast, the Gulf Coast, the Midwest, and up to the Canadian border. A broad cross-section of companies, from those involved in exploration and production of natural gas to substantial consumers of energy, can use natural gas futures and options contracts to hedge their price risk. Natural gas futures and options provide individual investors with an easy and convenient way to participate in an essential energy market and trade futures contracts nearly 24 hours per day, 6 days per week. So natural gas futures can see volatile price swings. So they call natural gas the widowmaker because there's just huge volatile swings. Very risky. I do have 3 contracts, but for me, I see that 2 does act as a very strong support. You can see that it did get under 2. This was back in April. That's when I started trading. I did get into futures back then and I was freaking out, and thankfully it did recover. It did bounce off from the 2 level because it was acting as a very strong support. And let's just go ahead and go back to a 5-year weekly chart, or even further than that, 10 years. You can see how many times it has gone down below 2. Very rarely. So it has gone down below 2 in 2016 and then in 2020. So ever since then, it's just been 2 and above. So today I'm going to go ahead and place a trade. So we're going to place a put credit spread. I'm placing a put credit spread is because it limits my downside, but also it limits my max profit, which is fine. So we're going to go ahead and do the November 23, which is it expires in 55 days. I also have one put credit spread already placed, but I'm going to go ahead and place another one today. And this time I'm going to go ahead and go to 2.9 and 2.45. So you can see my cost of trade, which I'm going to be receiving back, will be $1,300. And the most I can lose is $3,170. So again, this is very risky, but there is a max loss and a max profit, which is very important just in case a trade goes against you. So I'm gonna go ahead and send this, and hopefully it does get filled. So you can see that it did get filled. So I can show you my positions. It's quite a bit. So I have 3 contracts right now. I'm currently up 1,400, and then I have a few spreads. I have 2 spreads that actually expires in October, so in 25 days. I'm gonna go ahead and see how this plays out, and hopefully natural gas can try to go above 3. I know that people either place futures or they can trade oil, but oil is, you can see that 10 years ago it was at 2,500, and the reason why is because they've been doing reverse stock splits. So just be very cautious of this. I highly suggest futures just because it's much easier to trade. Unlike oil, if you buy options, they expire. If you buy shares, you're prone to possibly a reverse split. So that's pretty much it. Let me know your comments, and let me know if you trade natural gas.